Let's be honest, student debt is something so many of us know all too well. Whether you're fresh out of college or well into your career, figuring out how to tackle those loan payments can feel like a never-ending maze that's hard to get out of. School's First Federal Credit Union is here to break down those repayment options in a way that's not just easy to understand, but maybe even doable. Here to help us manage student loans, we have Nathan Calhoun, Calvine Point Branch Manager at School's First Federal Credit Union. Hey, Nathan.
Good morning.
Good morning. So, Nathan, for those of us dealing with federal student loans, where should we even start when it comes to figuring out how to pay them off?
Great question.
Yeah.
You know, federal student loans actually account for 92% of all student loan debt that's out there. So this is definitely an important topic to a lot of folks out there. When you're trying to get a start on how to repay your student loans, a great place to start would just be getting an idea of the balances on all your varied student loans. And I say varied student loans because they could actually be on different loans. You know, you think about going to school for separate years and you're financing each year. So a great place to start where you get a picture of the entire student loan debt would be the federal student aid website, which is studentaid.gov. There you can log in. You'll see your principal balances, you'll see your current balances, and you'll see the interest rates. Once you're equipped with that information, you're in a great place to go ahead and start looking over your repayment options.
Okay, and it sounds like borrowers have some options when it comes to repayment.
Absolutely. So with student loans, repayment options break down into two different plans. The first one is a fixed repayment plan, and the other is the income-driven repayment plan. The fixed repayment plan basically sets you up with a fixed payment amount that's set to pay off your loans and accumulated interest over a set period of time. That period of time is generally going to be anywhere from 10 to 30 years. The nice thing about a fixed payment, it's very easy to plan for. You know when your payment's going to stop and you know how much it's going to be every month, so you can budget for it easily. The income-driven repayment plan is a plan that does set you up with a payment amount, but it factors for things like your current level of income and your family size. This is a very nice repayment plan for folks that have a large amount of student loan debt in relation to their income, because it's going to set you up with a more budget-friendly payment. Other key thing about the income-driven repayment plan is that after about a period of about 20 to 25 years of paying, you could actually have any leftover amounts forgiven, which can be a great reprieve for those who've been paying for a long time.
Yeah, that's awesome. Okay, go ahead.
Oh, and I was going to mention, if you don't select either one of those, you'll generally get set up with a standard repayment plan, which is just a fixed payment amount, but it pays it off over a 10-year period. It does not account for your current level of income, so it can have a higher payment amount, but it'll pay off your loan the fastest.
Okay, it's good to know that there's options out there. What about folks who have more than just one student loan? Is there a way to make paying them off a little less overwhelming?
Yeah, you can think about consolidating your loans into one loan. The benefits of this is generally, you know, it makes your bill paying a lot easier. You're going to take all your loans and put it into one payment, essentially. So one payment versus multiple payments, one, you know, payment amount versus varied payment amounts, simpler. The other thing is generally when you take debt and, you know, compile it all together, lenders will give you the option to have a much longer term of your loan. For student loan debt, that can be as high as 30 years. So you're going to get a much more affordable payment in that situation.
Okay, sounds like a good option for people who have multiple loans. Are there any downsides we should keep in mind, Nathan?
There are some important things to factor in and think about before you pull the trigger on a consolidation. The first is we mentioned stretching your loan debt over a long period of time. Well, you're still paying interest that entire period of time. So generally, you know, if you do that, you're going to pay much more interest over the long haul than you would have with a shorter term. The other thing is if you do a debt consolidation, you can exclude yourself from certain you know, borrower benefits that are available out there, whether that be like rate discounts or principal rebates or debt cancellation that would only be available under federal student loan programs. The other thing is, as we talked about debt forgiveness, if you're on some sort of plan that offers debt forgiveness and you do a debt consolidation, there's a chance that you could reset your payment account and put yourself further away from your goal of getting that debt forgiven.
Okay, all helpful tips as we talk about student loan repayment options. Thank you, Nathan.
Thank you.
All right, to our viewers, you can visit one of the many Schools First Federal Credit Union branch locations as seen on the screen. And you can find out more online by going to schoolsfirstfcu.org.